McGraw-Hill Audio presents What Works on Wall Street, a guide to the best-performing investment strategies of all time. Written by James P. O'Shaughnessy. Narrated by Michael Kramer. Preface. Patrick Henry was right when he proclaimed that the only way to judge the future was by the past. To make the best investment plans for the future, investors need access to unbiased, long-term performance results. It doesn't matter if they are aggressive investors seeking fast growth or conservative investors seeking low-risk, high-yielding stocks for their retirement account. Knowing how a particular investment strategy performed historically gives you vital information about its risk, variability, and persistence of returns. Access to long-term performance results lets you make informed choices based on facts, not hype. This third edition of What Works on Wall Street continues to offer readers access to long-term studies of Wall Street's most popular investment strategies. Prior to its initial publication, no widely available comprehensive guides were available to which strategies are long-term winners and which are not. Here, I show how a careful reader of earlier editions could have avoided much of the carnage the bear market of 2000 through 2002 inflicted simply by avoiding the types of stocks that, while popular during the stock market bubble of the late 1990s, had historically shown themselves to be horrible long-term performers. All these recommendations were in place prior to the stock market bubble and ensuing bear market. Most of the advice derived from this long-term analysis is the same today as it was 9 years ago. Of great interest is to see how well these strategies have performed in real time, thus helping us take the guidance history offers us to heart. All the tests in this book continue to use Standard & Poor's CompuStat database, the largest, most comprehensive database of U.S. stock market information available. In this edition of this book, I use FactSet's Alpha Tester and Backtester to run the tests. Origins. It took the combination of fast computers and huge databases like CompuStat to prove that a portfolio's returns are essentially determined by the factors that define the portfolio. Before computers, it was almost impossible to determine what strategy guided any given portfolio. The number of underlying factors, characteristics that define a portfolio like price-to-earnings, P/E ratio, dividend yield, etc., an investor could consider seemed endless. The best you could do was look at portfolios in the most general ways. Sometimes even a professional manager didn't know which particular factors best characterized the stocks in his or her portfolio, relying more often on general descriptions and other qualitative measures. Computers changed this. We now can analyze a portfolio and see which factors, if any, separate the best-performing strategies from the mediocre. With computers, we also can test combinations of factors over long periods, showing us what to expect in the future from any given investment strategy. Most strategies are mediocre. What Works on Wall Street shows that most investment strategies are mediocre, and the majority, particularly those most appealing to investors over the short term, fail to beat the simple strategy of indexing to the S&P 500. This book also provides evidence that conflicts with the academic theory that stock prices follow a random walk scenario. Rather than moving about without rhyme or reason, the stock market methodically rewards certain investment strategies, while punishing others. What Works on Wall Street's 52 years of returns show there's nothing random about long-term stock market returns. Investors can do much better than the market if they consistently use time-tested strategies that are based on sensible, rational methods for selecting stocks. Discipline is key. What Works on Wall Street shows that the only way to beat the market over the long term is to consistently use sensible investment strategies. 80% of the mutual funds covered by Morningstar failed to beat the S&P 500 because their managers lacked the discipline to stick with one strategy through thick and thin. This lack of discipline devastates long-term performance. Highlights. After listening to What Works on Wall Street, investors will know that most small capitalization strategies owe their superior returns to micro-cap stocks, having market capitalizations below $25 million. These stocks are too small for virtually
Sample complete. Ready to continue?